Jim Brogan joins us on the Triple H Radio Experience, and I get to see you, though, today because I'm looking at you on Zoom. Thank you for joining us.
Yeah, I like the face-to-face so much better. It's nice to be looking at you.
I have so many things that I want to talk to you about. The first thing I want to talk to you about is the economy in general. I don't think we've ever seen anything like this. March hits, coronavirus hits, and the Fed decides we've got to do whatever is necessary to keep the economy afloat. So on the side of the Treasury and the Fed, they start pumping liquidity into that side. And then the federal government said, we've got to do anything we can to stabilize because we got so many people unemployed and we're asking people to stay at home. So we start to pump money on that
That's
side.
right.
When I looked at the books for the year, it looks like before we got 9 months into this year, we were $9 trillion into trying to save the economy on the Fed side and on the direct payment side. The interesting thing with that is, what does that do to the economy as a whole? Because everything that's happening, and you help me if my words are wrong here, everything that's happening is artificial. The stimulus is just propping up something. But if you took all of those interventions away, we'd be in a mess.
We would. We might have ended up in a depression if we hadn't done all this. So, and largely that's the Federal, that's a big piece of what the Federal Reserve, what they're trying, they're supposed to do. And then Congress, of course, has stepped in. It's interesting when you ask about the economy, Hallerin, I was thinking a couple of things while you were going through there. One is the GDP numbers have been, believe it or not, it's very highly correlated to the number of deaths from coronavirus. So that's just something to watch as we move forward. The economic output, there's just been a very strong correlation to the number of COVID deaths. Okay, so that's kind of fascinating. But then really what you're saying is, hey, we've thrown an enormous amount of money at the problem. And I would probably add on to there, how much more money do we need to throw at the problem, or are we likely to throw at the problem? But I would equate it to heroin. I mean, heroin, the stock market, it's like heroin for the market and for the economy. And so the Fed has taken really some unprecedented actions in bailing out corporate America and helping support the economy. And then, of course, we know what Congress is doing. And hey, they're going to do more stimulus. I don't know if it's going to happen before the election. I'm thinking it probably won't. But whether that happens in a lame duck or in January, we're going to have more stimulus. But, this pandemic's going to last for a while. I mean, I don't think we're right around the corner from this thing ended. I mean, whatever they do now, Hallerin, I hate to tell you, but it's not going to be enough. There's going to be more stimulus on into 2022, 2021, I think, as we get into maybe the spring and summer months.
So you advise people, the big idea has always been, if you go long on America, you always win. Like Buffett says, stick it in an index fund and quit watching the daily ticker, you're going to be fine. Is that still the case? How are you advising people when it comes to their portfolios? Let's say I got $5 million with you and we've got it split up between stocks and bonds and precious metals and real estate. And I don't know, however we have that. How are you balancing portfolios to deal with the reality of an American economy that is not as good as it seems, as being propped up, and an economy that will have to, stabilize?
Well, that's right. Well, when we look at the long haul, because this will eventually be in our rearview mirror, we will eventually have a post-COVID world. And then what's that going to look like? And there are some structural issues there with core unemployment. I mean, we probably permanently lost some jobs in America. Our core unemployment when this is all over and everything's recovered, probably going to be 6%. And we were down at 3.5% before this started. I mean, think there's jobs that we've lost permanently. But you're right. it's never been, you never want to bet against America. And I think there's always opportunities, Hallerin, but there are some pretty big challenges. And I think over the next 4 years, we're fundamentally seeing a change in our economic system. And I think it's not only happening here, it's happening all over the world. But if you look at interest rates, I mean, you typically, everybody says, okay, we got stocks and we got bonds. Well, interest rates are at historic lows. Now, they can go a little bit lower, but they can't go much lower. And the Fed is going to artificially keep interest rates low, no matter that they actually want to spur inflation and keep interest rates super low.
Because so then if I've got bonds in my portfolio, they're not producing.
No, I mean, if interest rates stay low, they're not paying anything. And if interest rates go up, they're going to do even worse. So I still think a diversified risk portfolio. Now, what does diversified mean? It means you have a whole lot of stuff in your portfolio that doesn't move up and down together. So if one thing zigs, another zags. Well, there's all, you mentioned real estate, you mentioned precious metals, there's commodities, there's non-traditional bonds. Those are bonds that have adjustable rates. It's kind of like a fixed rate mortgage versus an adjustable rate mortgage. So when interest rates go up, they automatically pay more. There are other alternatives to just traditional stocks and bonds. But a diversified portfolio over a period of 5 to 10 years, if interest rates are probably going to be kept low at least for the next 3 or 4 years, is still more than likely, Hallerin, going to be our best way to fight inflation and try to earn more. That's really the key over time, is to earn more than the cost of living increases. And so it's still, in my opinion, going to be the best way to make money. And there's always opportunities in investment capitalism to evolve a portfolio and take advantage of opportunities. The issue is getting there might be kind of, volatile in the short term. So any needs we have in the short term, Hallerin, we've got to have things that are stable or protected and aren't going up and down in the stock market. So
let's stop there for a moment then and just talk about what's stable in times like these.
Well, there's really only a few choices. I mean, you could have, especially for short-term stuff, you could have money at the bank, in a money market, in CDs. CDs are paying nothing. But, that's not always the case. Sometimes CDs can have their place in a 1, 2, 3 year CD ladder. Okay. But that's one option. You could buy, there are things called guaranteed interest contracts, which are like CDs, but they're with insurance companies. You have a 3-year guaranteed interest contract. An A-rated company, you can get in the 2s, which is a lot better than a CD. There are also bond funds that buy bonds that are really, really short in length, 2 years in duration, less than 3 years. They're so short, they really shouldn't be much affected by the market. So that would be more stable. They're not guaranteed, but they're stable. So there are things out there that you can go to in the short term. But I do think, Hallerin, when you're looking out 5, 7, 8 years, you still need a diversified portfolio. You just need to not worry about what's happening in the next 6 to 12 months, so it all fits together like that.
Why don't we take a break? When we come back, I want to talk about the mindset of a stable investor. How do you keep your mind clear? How do you not give in to the anxiety of the moment so that you don't make your investment decisions based on your anxiety, but you seek wisdom and you follow that?
Yeah, I think that's a great word.
Is my guest. Jim Brogan is my guest on the Triple H Radio Experience. More in a moment. All right, let's do this next segment. Jim Brogan joins us on the Triple H Radio Experience, and you might be watching this as well, since we linked up on Zoom to do this. Thank you for taking the time to talk to me today. So we talked about all of the stimulus that is going on, what's happening in the U.S. economy. We had a juggernaut of an economy, and then it was shut down by coronavirus. We're trying to build our way out. We're watching restaurants and businesses build back capacity. But this economy has some real soft spots. I'm noticing that in commercial real estate, there's a lot of frustration in commercial real estate. People working from home is transforming the commercial real estate landscape. But then we're coming to this stimulus peak. And what we're finding is people were using stimulus to pay rent. and there were some rent moratoriums and that kind of stuff. And now residential rental property and that kind of stuff is being affected. We're seeing a huge spike in precious metals, but then you have some companies that are seeing a tremendous surge. Zoom, Netflix, all of the FANG companies,
Big
Facebook,
technology.
Google, all of the big technology companies are on a hockey stick. Everything else, the airline industry, I noticed that the busing industry furloughed about 80,000 people because of travel. So trying to figure out, number one, how to remain calm as an investor, and number two, how do you diversify a portfolio with these economic variables going on?
Those are great questions, Hallerin. I think in terms of staying calm, you know, you're hitting something so important for an investor, because our behavior, investor behavior, is so, if we look at history, Hallerin, it's so counter. If we look at what investors as a category do, it's counter to their best interests, right? And that's because emotion. Emotion is maybe one of the top 2 or 3 enemies of investing. You know, we know we're supposed to buy low and sell high. Unfortunately, our emotion, we want to buy when things are great, when it's high, and then when things are down and things are bad, we want to sell. So behavior is so important. So I think the real key there is for investors to build a financial plan that they understand how it tackles different risks that are out there. I mean, we know markets are unpredictable, and we know that markets are volatile. So it shouldn't surprise us when we have a bear market. We never know the source of the next bear market. You know, could anybody see a pandemic coming? No. But we know bear markets happen. And we know investments are volatile in the stock market. So the key is, if we know that we've got a plan that mitigates the effect of that volatility, and a lot of that is having those risk investments invested for, you know, 6, 7, 8 years from now. So if we know we have a plan to mitigate that, and we understand our plan, we're less likely to have and make behavioral mistakes. Okay, that'd be my biggest input.
Right. So I guess that's where what you do, and I think that's one of the things that I really like about what you do. You're a teacher, because when people have more information and they understand, our strategy is built around these components. You just kept saying that if you understand what you're doing strategically, if you understand that volatility and risk are part of what it means to invest, we can manage the risk. We can manage the portfolio.
Well, that's right. And we can even measure risk and have a pretty good expectation for what that might look like. I mean, we know the past, you know, we don't necessarily know what we're getting in the future, but believe it or not, measuring risk is a pretty good predictor of future risk. So if we know what we're shooting for, and you know, I'm a big believer, Hallerin, we invest for outcomes. We don't invest just to invest. We're trying to accomplish something specific. And if we keep the eye on that, and we understand those risks and how our plan mitigates those risks, then we don't get outcomes that are wildly variable from what we would expect. And then we're less apt to panic and make a knee-jerk reaction.
All right, so let's do this. I would love to wrap our time together by you giving our listeners some tools. Give us some tools. As we've wrapped this year, as we look to 2021, you are advising your best clients. When you're giving your best advice, you're telling them to do these 3 things, or you're telling them to do these 5 things, or you're telling them to do this one thing. We now sit at the feet of the great guru. We've come to the mountain. we are waiting here at the mountain to receive your financial wisdom as we wrap this year, so we can go into next year strong.
That's great. Thank you for that, Hallerin. But I think that the tools are so important. So the first thing I think you need to do is, you know, the market is up near all-time highs again. So it's a great time to be looking at all this. The first thing is, you've got to secure your income and cash needs for the next, I think, 5 years, minimum. In other words, you know exactly where you're going to get that money from, whether that's income or a purchase in 2 years. You know, young people, if you're getting a car in 3 years, whatever it is, any income or cash needs you have in the next 5 years, that money is stable or protected, like I talked about a minute ago, and you know where you're going to get it from. And it's not in the stock market. So if the market goes down next week because of uncertainty over the election, you're not worried about it because you don't need that money right now. So that's number one. Number two, assess the risk you're comfortable with and measure that risk. Measure your portfolio, understanding the risks you're taking to where you don't open up your statement in 6 months or a year or 3 months and you see something on that statement, or you log in online and you see something that makes you gasp and want to panic and make a mistake. And then number three, invest for that outcome. What is it specifically that you want to accomplish with your money, and when will you need it? Money you don't need for 20 or 30 years, Hallerin. I do think you should be invested largely in the U.S. stock market. You should have some foreign stock exposure. But, money you're going to need in 7 or 8 years, you can't be as aggressive. So what do you need and when are you going to need it? So those would be my three takeaways. What are you going to need the next 5 years? Measure the risk and take risks that are acceptable to you so you don't get a big surprise. And number three, when do you need it? Or what do you need out of your money and when do you need it?
All right, Jim Brogan, how do people get in touch with you?
They can visit us online, broganfinancial.com. Hallerin, people can sign up for my e-newsletter. It goes out every week with all kinds of content, video blogs, guides, whatever people want. So they can go to my website at broganfinancial.com. They can also call us if they like, 865-862-6800.
You've got a great Saturday morning radio show as well. Let's not forget that.
Thank you very much. I love doing the radio. Believe it or not, Hallerin, it's been 16 years now. No, I'm sorry, 15 years on the air.
All right, so tell people when you're on so they can tune into that as well.
I'm on Saturday mornings, 9 to 10 a.m. right here on News Talk 98.7. And this Saturday, I'm going to talk a little bit about our history in the United States from an income tax perspective. Many people are concerned, where might we be headed with income taxes? And there are some parallels, Hallerin. If we look at World War I, World War II spending, things in our past, we need to understand those things because it could impact how things are happening in the future.
All right. Jim Brogan, thanks for joining us on the broadcast.
Thank you. My pleasure.